Hi, I'm Andrew Gregory, and this is my partner Reed Sloat. We're with Freedom Street Partners, and we're continuing our series on communication through our email campaign to really try to get some great information to our clients on some of the things and some of the topics that you guys are most worried about. I want to start with inflation. For 2022, and really at the end of 2021, inflation has kind of been in the headlines quite a bit.
Oh yeah, every day.
Yeah, and Reed, as our branch manager and dealing with the 40 plus advisors that we have in our team, what are some of the things that you're seeing that are being communicated to clients?
Yeah, I appreciate it, Drew. This is definitely what I hear most from advisors and from clients, is inflation and some different strategies around how to navigate this market. One is, I think we always have to recognize that there are things that are in our control and things that are out of our control.
Sure.
And inflation's not in our control, right? And so while it's here, and while we think it'll be around for a little while, there are signs that supply chain is going to get better, that things are going to get a little bit easier on that side of things, which should help slow the pace of inflation down, right? And that will bring some relief, right? That'll bring some relief to all of us, right? As any of us have gone to the grocery store, been to the gas pump, we realize that it's definitely taken a toll, and things cost more than they did. And so, but because we can't worry about it, we gotta own things that do well in those environments,
Sure.
right? That's really important. So we look at we peel back our toolkit and we say, okay, well, what does well in an inflationary environment? And the first thing that jumps off the page every time is quality dividend paying equities, right? Companies with good balance sheets that have a track record of consistently raising that dividend over time. That's really what we got to look at. That's where we got to start. That's square one.
That's a great point.
But there are definitely other things. Drew, we were just talking at lunch about some other things. What stood out? What are some of those out of the toolkit that we need to focus on?
Sure.
Or our clients need to focus on?
Well, look, I think the U.S. economy has a lot of different sectors, and some of those sectors do better during an inflationary environment than others. Some economists and some research folks, especially here at Raymond James, they would speak to things like industrials. They would look at materials companies. Financials tend to do a little bit better during a rising rate environment and during an inflationary environment. But speaking of inflation, I think the place where clients feel that the most and what they talk about the most is energy and oil. Talk a little bit about oil prices and maybe some of the investment themes and strategies that we can utilize to offset the pain at the pump, so to speak.
Yeah, absolutely. Well, everybody who's been at the pump knows that energy costs are going up. They feel it, we see it. And again, it's out of our control, but you should have some of your assets exposed and directly in energy, right? So at least as those prices are going up, you're participating in it as well. While your bank account might not be, your investment account can. And so we want you to, this is something that we've taken into account as we look at all of our clients' account, is making sure that we're appropriately allocating, making sure that clients have some exposure to that energy sector, because it's an important one to own right now.
It's a great point. I think one of the other topics that you probably see on TV quite a bit and that our clients are asking a lot of questions about is the Federal Reserve and their role with all of this inflation talk and the tools in their toolkit that we definitely don't have any control over, but we hear a lot about it. And so, the Fed has already announced that they're going to start tightening is the buzzword of the day, which means raising interest rates and reducing the size of their balance sheet. And that's going to have an impact and a ripple effect through our economy in good ways and sometimes bad, but we just have to be prepared for those things. Reed, take just a couple of minutes and talk a little bit about the Fed's role, the tools that they have, and what they're talking about potentially doing here in 2022 and how it might impact client portfolios.
Yeah, first I think it's important to take a step back and recognize that when COVID started, the Fed acted quickly. They decisively cut rates. They brought rates down to zero on the Fed fund overnight rate. And then very soon after, they started buying bonds every month, right? So this is called quantitative easing, right? So they're creating liquidity in the market space. These are a couple of the tools that the Fed has. Well, that's one side. The other side is that they they got to slow things down sometimes, and inflation's one of those things that they want to pay attention to. They don't want it to get carried away. And so in order to help do that, now's where we're going to see them stopping that bond purchasing that they've been doing, they're still doing, that they don't actually end until March of this year. And then shortly thereafter, they're going to start to raise rates. When the Federal Reserve raises rates, they're literally taking money out of circulation, right? This is intended to slow things down, right? That's what they're trying to do. They don't want inflation to run away from us, right? And so they're going to raise rates. How many times? I don't know. There's been lots of headlines. We have different firms out there, different analysts that are saying 3, 4, 5. I just read one where it said 8 interest rate hikes this year. While we certainly don't believe that there'll be that many, that doesn't mean that we have any control over this, right? The Federal Reserve, its committee is going to meet. They're going to look at the big picture of what's going on, and they're going to try to assess and make the right call to help things. An important point to this, though, people often the market gets really nervous around rate when the Fed starts to raise rates. It gets kind of spooked. I'll remind people that in 2019, the Fed raised rates all throughout that year. I think it was a pretty good year, if I recall, close to 30% on the S&P 500 that year. We'll be okay. We've seen this before. It is not new. And so those are a couple of the tools, right? They cut rates when things are not, when things are in trouble, when we need to create more liquidity, make it easier for investors to, make rates on loans lower, right? But now, one of their other tools is to raise them back up. And it actually is a positive thing because now they have that tool again. Right now, they don't have the ability to cut rates. Rates have been at zero, right? So by raising them, it gives them some tools in case things go sideways. And I don't know what that will mean. I don't know why things go sideways. I certainly didn't see this pandemic coming, but it was a huge benefit that they had started raising rates before 2020, and they had that tool to be able to pull out of their toolbox and use in order to help us.
Yeah. I think none of us envy the position of the Federal Reserve and the decisions that they have to make. Anything can happen. We've seen that in our history. So the Fed could start to raise rates this year, and midway through the year, they may see different economic data that says they need to pause or they need to go a completely different direction. So we'll continue to rely on them to make those moves. And then us as financial advisors will continue to control the things that we can control when it comes to managing our clients' assets and working around life events that our clients are dealing with on a day in and day out basis. And to that end, I think what we wanted to close with was, your portfolio and, what type of investments should we be looking at in this type of environment where there is a little bit of economic uncertainty. And there are some things that we haven't dealt with in quite some time. And the thing that I remember, or one of the quotes that I remember that I think is helpful in times like this is, don't buy an investment today that you wouldn't want to own in a recession tomorrow. And we're not predicting a recession. We're not telling you that we're going to have a massive, economic slowdown, but you can control the types of companies that you're buying. And our investment policy committee, in conjunction with Raymond James Asset Management and the investment policy committee with Raymond James and their strategic allocations, they're looking for those types of companies. They're looking for companies with good balance sheets. They're looking for companies with good leadership. They're looking with companies that pay a great dividend, and maybe they've increased that dividend for many years in a row, sometimes 10 and 20 years in a row of dividend increases. So in times of inflation, in times of uncertainty, you go to quality. You look for companies that have proved themselves throughout the test of time. Nothing will guarantee that outcome, but those types of investments will give you the best opportunity to have the success that most of our clients are looking for. Read, anything that you would add on the equity side as far as the types of investments that we're really trying to focus on here as the uncertainty picks up?
Yeah, absolutely. I think it's important to diversify. Oftentimes we get really focused on the S&P 500, right? And it's been a great place to be the last 2 years. Those FANG stocks have ripped and it's pulled the whole index up. And so sometimes we get a little too focused on just large cap stocks. And there's other places to go. We see opportunity in the small and mid cap space, right? We don't want to go overboard there, but it's important to diversify, to actually spread out how you have your assets allocated. And so, those are another great place to further diversify your portfolio, to talk to your advisor to make sure that you have some exposure there. You're not all in those FANG stocks or all in just the large cap growth, but we want to make sure we have that value that you just talked about, have those quality names, and then have some other sectors of the other indexes that maybe we don't always have exposure to, and we need to.
I think to close this out here, I think, I lean back on our process. And our process, you've heard us talk about it a lot. It's life and wealth optimization. And the things that you've heard us talk about today, a lot of these things are things that we can't control. We can't control interest rates. We can't control inflation. We can't control the price of oil. We can't control what the Federal Reserve is going to decide. We can't control what the equity markets are going to do and how quickly they're going to go up or down. But what we can control is having conversations with you, understanding which of these things is most important to you and that you're most concerned about, and then identifying historically what have been the best solutions in order to combat those things and to stay ahead of it. So, as always, call us. Click on the link below, and let's continue to have a conversation as things continue to develop. We really appreciate you taking the time to hear us out today, and we'll talk again soon. Thanks.